Learning Forex takes 6 to 12 months. The order you learn it matters more than the strategy itself.
6 to 12 months. That's the realistic timeline before you should put meaningful capital into a Forex trade. Not 6 weeks, not the Forex Profits in 30 Days course you've been pitched on Instagram. 6 to 12 months of actual study, demo work, and live practice at sizes that don't hurt when they go wrong. And here's the part most beginners get backwards. The traders who blow up in year one didn't pick the wrong strategy. They had the right strategy at the wrong time, or no risk framework around any strategy at all. The order you learn this stuff matters more than the strategy itself. Remember that line. We'll come back to it. There are 8 steps, in sequence: macro understanding, market structure, product mechanics, risk management, one strategy on one pair, demo trading, live with minimum size, and slow scaling. Skip any of them and the rest collapses. Why? Because each step is the foundation for the next. You can't pick a strategy until you understand the product. You can't size a position until you've built a risk framework. And you can't survive a real drawdown until you've felt one on a micro lot first. The shortcut version sold online, 6-figure mentorships, secret signal groups, guaranteed return discords, exist because skipping steps is exactly what most beginners want to do. It's also why most retail accounts lose money in their first year. That's not an opinion. That's the disclosure regulators force brokers to publish. Step 1 and 2, macro and market structure. The first few weeks are pure reading. Currencies move on 5 things: interest rates, inflation, growth indicators, trade balances, and risk sentiment. That's it. The Fed, the ECB, and the Bank of England publish everything you need on their policy pages for free. Skip the YouTube macro influencers until you've read the actual source. Then structure, sessions, liquidity, spread behavior by time of day. The same strategy that prints during the London-New York overlap can quietly bleed you during the Sydney Open, because liquidity is different and spreads widen. If you don't know that, you'll blame the strategy when the real problem is the session. The BIS Triennial Survey is the single best document for the overview. Read it once. Step 3, product mechanics. What you trade depends on where you live. In Europe, the UK, Australia, and most of Asia, you're trading CFDs, spread plus swap taxed as capital gains. In the US, spot through an NFA-regulated broker. In the UK specifically, spread bets, tax-free for retail, a real structural quirk. Globally, currency futures through the CME, with the US Section 1256 60/40 tax split. Same Euro-US dollar price, completely different cost per trade and after-tax return depending on which wrapper you pick. Pick your product before you pick your strategy, not after. Step 4. This is where most retail education sprints ahead and where most retail accounts blow up: risk management. The non-negotiables. Risk a small fixed percentage per trade, 0.25 to 1% of equity, never more. Stop loss on every single trade, set in the platform, not in your head. Daily loss limit. When you hit it, you stop, even if your next setup looks like the best you've ever seen. No averaging down, no revenge trading. And your trading account is not your emergency fund. Now the rule that actually separates survivors from casualties. Position size is derived from stop distance, not the other way around. Decide your maximum loss in dollars first. 1% of a $5,000 account, so $50. Decide where the stop goes based on the chart, not your wallet. Then size the position so hitting the stop equals exactly that $50. Do that every trade, no exceptions. A mediocre strategy with this discipline beats a brilliant strategy without it, every single time. Step 5 through 7, one pair, one strategy, then 3 months of demo, then live at minimum size. You pick one pair, Euro-US dollar or GBP-US dollar, the deepest liquidity and smallest spreads. One time frame, one strategy, trend pullback, mean reversion at a defined level, opening range breakout. It barely matters which. Pick one and learn it deeply. Then write every rule down. Entry, stop, target, position size formula, time of day filter, no trade conditions. If you can't write it down, you don't have a strategy, you have a feeling. Then backtest manually. Scroll through 6 to 12 months of charts on your time frame and mark every signal. See what the equity curve actually looks like. Demo for 3 months minimum. Same platform you'll go live on, same rules, daily journal, weekly review. The demo isn't there to make you profit. It's there to prove you can follow your own rules when nothing's on the line. Then the gap nobody warns you about, demo to live. This is where most accounts actually blow up. Not later, here. Why? Because demo doesn't teach the psychology of real losses. It doesn't teach slippage on a Friday afternoon NFP spike. It doesn't teach what your heart rate does when you're down 2% on a position you're sure was right. Most traders find their decision making is meaningfully worse on real money than on demo, and the entire point of the live minimum size phase is to discover that gap at a price you can afford to pay. So go live with the smallest position your broker allows, 0.01 lots, a micro lot. Capital you can lose without changing your lifestyle. Same rules as demo, no improvisation, no size increase for 3 months. The goal is not profit. The goal is calibrating your psychology to real money. Then you scale, slowly. Double to 0.02, trade for a month, review the journal. Did discipline crack? If yes, scale back. If no, double again. Most profitable retail traders eventually plateau at a particular size and just stay there for years. That's fine. The largest size at which you still follow your rules is your current ceiling. Where do you get the actual material? Free, mostly. The BIS for structure, central bank sites for policy, FCA, ESMA, ASIC, NFA, CFTC for regulation and scam warnings, baby pips for the long-running beginner school, broker academies from Saxo, IG, Interactive Brokers, and Schwab publish genuinely useful free content. Coursera and edX for university finance courses you can audit for nothing. What to avoid? Paid mentorships with strong sales pages and weak track records. Telegram and Discord VIP rooms as the main product. YouTube channels promising guaranteed monthly returns. Anyone marketing the lifestyle before the curriculum. The FCA and ESMA both publish active warning lists of known scams targeting retail forex traders. Check any mentor or broker against the register before you pay them a cent. Guaranteed returns and secret strategies are marketing for high risk or outright illegal operations. Always. So back to that opening claim, 6 to 12 months before meaningful capital, and the reason has nothing to do with strategy. Here's what the calendar actually looks like. Month 1, macro. Month 2, structure and products. Month 3, risk framework written down. Month 4, one strategy backtested. Months 5 to 7, demo. Months 8 to 10, live at minimum size. Months 11 and 12, the first gentle scaling. Remember the line from the start. Most failed traders had the right strategy at the wrong time, or no framework around any strategy. That's why this order exists. Macro before strategy, because strategy depends on regime. Risk before position, because size depends on stop. Demo before live, because rules need testing before money's on the table. If you're willing to do this, boring, sequenced, journaled, slow, you're in the minority that survives year 3. If you want the shortcut, the disclosure is clear. Most retail accounts lose money in year 1, and the shortcut is the reason. The path is dull. It also works.
6 to 12 months, in order, journaled, and slow. Full breakdown linked in the description.